Good morning, ladies and gentlemen. Welcome to today's lecture by Professor Sir James Mirrlees, jointly brought to you by the Ministry of Trade and Industry and the Civil Service College. This lecture is part of the 5th ASEAN event series entitled Bridges, Dialogues Towards a Culture of Peace, facilitated by the International Peace Foundation. Please turn off your mobile phones or switch them to silent mode. We have enclosed a feedback form in your program card, and we hope that you will take some time to fill up your views and suggestions. We will begin today's program with a welcome address by Dr. Tia Jongping, Director of Public Economics at the Institute of Governance and Policy at the Civil Service College. This is followed by the presentation by Professor Sir James Mirrlees, and we will have a Q&A session moderated by Dr. Yip Chun Sing. Ladies and gentlemen, please put your hands together for Dr. Tia Jongping for his welcome address.
Hi, good morning. Hey, good morning. Yeah. Is that okay? Just now we were just trying to help Professor Mirrlees set up the computer well, and so that he will present there instead of here because he needs to see his slides. Yeah, in case you're wondering what we're doing there. Anyway, it's a great pleasure to support the International Peace Foundation Bridges Dialogue event in their effort to facilitate conversation and dialogue within ASEAN. We are thankful to UA for bringing Professor Mirrlees here, and when I look through Professor Mirrlees' distinguished CV, I can't help but notice that he was born in Scotland, but educated in England, and now with the more devolution of taxation powers to the Scottish Parliament, I wonder what he would do differently in Scotland than he would do for the rest of the UK. And maybe it's time to set up the optimal tax system for Scotland. And as a small open economy, Singapore is determined to maintain a competitive business environment, and that includes keeping our tax rate low to encourage work, to encourage enterprise. Yep. But today we are faced with rising income inequality, and in part driven by globalization, and also in part driven by technological change, as the researchers have documented these facts. There is also increasing awareness of the level of wealth inequality, and I'm sure many of you have read the thick book by Thomas Piketty about the evolution of wealth over the last few centuries. Maintaining a sustainable social compact has become an increasing challenge for Singapore. So it is really a good time to refine, to think about our policies, and to think about the trade-off between having more progressivity and efficiency. I would just like to finish up my point to say at a personal reflection. The entire tax and spend, the entire way the tax structure is designed, it is never going to be just about a positive analysis about your efficiency, what is the best, and all these things, right? A lot of times, normative issues matter a lot. Take the poll tax, for example. It is going to be efficient, but it is just not. It just doesn't pass the hurdle of what we think of a fair society and a fair way to distribute, right? So, tax and spend it's necessary to talk about norms, social value, fairness. And it is also important that citizens be engaged in the process as well, because these are not just things that can be settled on a positive, based on positive analysis, right? So it is in this context that I felt that some conversations about the policies and the way they are designed is very important to forge a consensus as to how we design the tax structure and in a way that's acceptable to a broad swath of society. Without further ado, I will invite Professor Mirrlees to share his views on this. Professor Mirrlees, thanks.
So since I was asked essentially to talk about the Mirrlees Review of Taxation, which was done by a whole group of people that I was sort of chairing, well, a highly cooperative arrangement. I thought possibly a good framework for me to talk around was the the introduction to it that we gave when we launched the review a few years ago, well, a couple of years ago, I suppose. The idea was to build on all the economic theory and evidence that had been developed. And I want to underline that it was inspired by a previous report that James Mead had chaired quite a long time ago, but that was the one that I sort of grew up on when I suppose it was done sometime in the 70s. We commissioned lots of papers. So if you go and look for the Mirrlees review, which you can do on the web, all the chapters and papers are available for download. Not quite sure how we managed to have an agreement with Oxford University Press that they could all be made freely available, but apparently they've done quite well out of it. So, an interesting calculation there. So there's a very fat volume and a fairly fat volume, which doesn't quite compete with Piketty, but fairly long. The very fat volume has lots of papers by other people and commentaries on them, which are often the most interesting part of the discussion, say on environmental taxation. I think this is a very good source. But the volume that the team really worked on was this second volume, and that's what I'm going to talk a bit about. We had all these submissions, but that's not what you want to hear about now. Well, just start with the obvious background that tax systems and tax and benefit systems, and we're thinking of both of them, designed to raise revenue, of course, finance government spending, and to redistribute. All of this is very familiar. And to correct what we nowadays call market failures. Obviously, this is fairly large, dealing with externalities, essentially. And people are affected by the whole system. We found, I was actually surprised that it's been very hard to get the lesson over that there are a number of equivalent ways, or almost equivalent ways, of achieving the same results. So one of the things that we keep finding very difficult, I know I find when I do radio interviews or something like, or media interviews, that they often come back again and again, that they can't understand that it doesn't make sense to ask whether it's better to have a sales tax or an income tax, because they can both do pretty much the same things, except that a sales tax is not so progressive. But they keep thinking that somehow or other, I mean, it doesn't offer the opportunities of varied marginal tax rates at different levels, at least not quite so easily. Sorry, we seem to have jumped back. So this is the sense in which people are affected by the whole system, that you can't decide that what you're going to do is to run through the particular taxes and say, yeah, this is one we should have, and this is the sort of level you should have it at. You have to find a way of talking about it that will explain general principles. I'll illustrate that easily. Of course, we can say things like this. You want cost individuals as little as possible, but the question is what really happens. So the principles that we wanted to insist on were, first, that people were responding to all the tax rates. The marginal tax rate is the sum of all the additional taxes paid when income increases by £1 or $1 or whatever it might be. We, in fact, I mean, this is something that the British government does get close to working out quite in some detail, but it's hard to track it down. And in the end, we don't actually have a picture in the volume that shows what that's like. I wonder if Singapore can say what is the total marginal tax rate at different income levels, including sales taxes, property taxes. Yeah, but it seemed to me, looking at the figures you'd sent to me, that you don't take account of the fact that there's an implicit land tax, because the land is essentially owned by agencies of government or government. I mean, it's such a complicated mixture. Yes, you have a property tax, but also the land is owned by agencies. Like I was hearing about, there's a JIT, is it? So, but when somebody pays a bit more to use some property which is owned by this JIT, and the revenue then becomes available to government indirectly. So in effect, this is pretty much equivalent to having ownership of land by the government, which is equivalent to having 100% taxation of rents from land. This is the kind of thing that's difficult to quite perceive and include. And it's not the kind of thing that gets into the British calculation either. So we did find that in Britain, these total marginal tax rates are, for many people, pretty high. And there were lots of middle-income people who had 70% marginal tax rate on their income or over that. And I think that's quite interesting in thinking how far you can go without doing immense damage to the level of GDP. Particular taxes, not in themselves then going to be green or progressive. It depends how the impact really works. We decided we would go with the general ideal of neutrality. And the way we applied that was based on the notion that the source of inequality, the fundamental source, was the difference in people's ability to earn income. That may be rather too British-centered, because in Britain, a number of authors, particularly there was work John Fleming did years ago, found that most of capital could be explained as being the result of accumulation, and that the inequality of wealth as measured could be pretty much explained as the result of lifetime saving with the inequality of income. So that was the basis for taking the view that the main source of inequality is the differences in labor income, that some people can earn a lot more. Of course, that's completely different from the view that Piketty and Sayers were taken, or at least Piketty's interpretation has gone that way. And it seems to be true that in America, for some reason, there's a lot of inequality of wealth that can't readily be explained as being the result of rich people growing older and saving quite a lot. But there's still more inequality. In other words, the obvious explanation would be that for some reason people in America are risk takers to a greater extent than people in Britain, so that then the inequality would arise from being lucky in your investments, as well as having a lot of capital because you've grown old and saved a lot. But probably inheritance has been more important in America as well. I suppose because inheritance tax is quite a high rate in Britain. Now, the main impact of the ideal of neutrality is that you should, on the question of whether you should tax different commodities, or different goods and services at different rates. Now that's a legitimate question, even although you've got this overall equivalence of sales taxes, commodity taxes, and the labour tax. It really is only an overall equivalence, and you can give a proper basis for wanting neutrality there. And this I want to develop in a little detail because it's one of the main themes of the tax review. I think it's actually in another slide, but I think I will pick it up now since it's time we got onto something of some substance. But the idea of neutrality here is that if you are going to have a sales tax, and I'll mention an argument why you might want to have that, it's of course called value-added tax in Britain and in European countries. That in Britain there's very considerable discrimination between taxation of different goods. So about half of people's spending is pretty much exempt from sales tax, whereas the rest of it has a value-added tax, which I think currently is at a rate of about 20%. Because I live in Hong Kong, I don't have to pay attention. I don't remember the exact rate. Anyway, you're not supposed to see the rate. You're only supposed to be told the price you have to pay, including the tax. So you're not constantly reminded, as you might be in some countries. So we said, well, that's not neutral. We're not against it, but there are really more fundamental reasons why we thought that that was not recommendable. And we prefer something like New Zealand, where it's pretty much the same value-added tax rate for every good and service that they can get their hands on. Come to the difficulty about getting your hands on things in a moment. The fundamental argument is that if the main source of inequality by a long way is differences in people's ability to earn income, then the only valid reason for wanting to tax different commodities at different rates would be if they interacted with labor supply in different ways. Roughly, the principle is that you want to tax something that is a substitute for labor, or if you prefer, in a sense for leisure. In other words, if there's something that if you consume it, it would really interfere with your work. The example I like to use would be detective stories, of which I'm rather fond. And if you spend time reading a book that isn't going to help your work in any way, then it's using up time that you could have spent on work. But if it's a textbook, or if it's Piketty's book, Capital, and you're an economist, then spending time reading that is probably going to help your work. So problem, you want sometimes to tax books and sometimes to subsidize them, but relative to one another. I mean, tax at a higher rate or at a lower rate would be the obvious way. And they got busy in the Institute of Fiscal Studies and tried to estimate the degree of complementarity or substitutability between commodity demands and labor supply, and didn't find anything that was significant. I can easily give real convincing examples of commodities that weren't in fact included in this study, but which seem to be pretty clearly complements with labor. Education is a clear one, and I think healthcare as well. So here we have an argument for saying that education should not be taxed as compared to other things that are taxed. Unfortunately, the argument, of course, doesn't give you very precise information about the extent to which you would want to subsidize education, relatively speaking. But the same kind of thing on healthcare. Although, again, I have the sort of puzzle that I don't know anything, what you could do about in practice. But there are a lot of sales of, let's call them patent medicines, or vitamins, for example, which pretty much shown not to have any good effect. And you don't obviously have the same argument there, but you manage to get people more time at work because they're not going to days off because of being ill, because you've actually cured them. So it's effective medicine that should be subsidized. The problem is how do you distinguish? And because this might be a fairly large category, it's a serious issue. And that actually makes me think how well taken the initial remarks were, because of course I'm talking as though all of these things will be determined by a welfare function in my mind, or the teams, whereas democracy might have something to say on a question like this. Well, these are two examples. Curiously enough, I think it's a nice illustration of what lies behind these principles. That if you take what about the argument that's often brought up that you should tax luxury goods at a higher rate? It's a contribution to dealing with inequality. Well, you can see that the argument lying behind this is that the source of inequality is the differences in the ability to earn labor income. So you should deal with that by progression in the income tax. So you've dealt with it there. You shouldn't also be trying to do the same thing further by dealing with luxury goods, which is actually a more inefficient way of doing it. And actually, if you think of the question, should you tax expensive wines more than cheap wines? Well, you might not spend much longer drinking expensive wine than the cheap wine. The deleterious or good effects of the alcohol are not going to be particularly different. So actually, as between these two, there is no reason to actually, plausibly, you should not be taxing the additional expenditure on more expensive, better quality wine. The same kind of thing, indeed, could be said as between luxury meals and ordinary meals. So I give that as an illustration to show what we're saying. And now, of course, quite a lot of the book, in effect, is then trying to deal with the implications of this kind of principle of wanting essentially neutrality between different kinds of things. So you have to deal with how would you arrange that the financial services are taxed at the same rate as other goods if you do have a value-added tax. And of course, the advantage of having a value-added tax I'll come to, that then you want it to apply to financial services, for example. You want it to apply to housing services. Britain has a rather strange system of property tax. As far as I know, the Singapore one is perfectly orthodox and proportional to some kind of valuation done with the property. Whereas in Britain, it happens to be done by a banded system, where your house is reckoned to be A, B, C, or something, and, which has the effect, which I underline that I'm not in favor of this. It has the effect that for richer people, and this even includes people like me, where the value of our house in Cambridge is way above the threshold level for the top. So it's now true for many moderately well-off people. And the tax doesn't increase with the value. When you're in a particular level, then you pay the tax for that level, and that's it. That's about as absurd as possible. You mentioned the Scottish case, and currently, of course, Scotland has very few taxing powers, but one area they've just been given land and buildings, and they're going to abolish this British arrangement and adopt a tax proportional to value, which of course will have potentially very large effects, which people don't seem to have noticed yet. We will no doubt get some kind of political convulsions, because this is a very interesting case because of the problem of making a reform of this kind. You can't make the reform a little bit at a time. And on the other hand, it seems very clear that it's an unjust system as it is. But if the system changed and it's the theoretical case where the prices of property don't change, of course that's most unlikely. Prices of property should all fall, and for the more expensive property they should fall quite dramatically. It's hard to see how everything can be done so that the valuations of property are those that rule after the adjustment of equilibrium prices. But there would be quite large ones. But I think one can reasonably make the argument that it ought to be a sort of proportional one, and that what you're trying to do is approximate to the effect of value added on housing. Mind you, it leaves the thought that perhaps just to have the value added tax on building, so that the taxes could be essentially paid right at the beginning when the building is created. So that's really where you'd like to get to. But we think the transition problems are really very big and didn't pursue that one. But we do think that at least one could have a land tax. Probably not as big as the effective one in Singapore, but although we wish we knew where the ownership of land is, because of course it's very dispersed. There would be a lot of it owned by charitable organizations, a lot of it owned by pension funds, probably, indirectly. So it's not quite clear what would happen, and no doubt there have to be special arrangements for charities. Well, of course, progressivity is the other principle, and this seems to be remarkably acceptable. But I should underline that the review decided it wasn't going to get into the issue of discussing how much progressivity there should be in the tax system, how much redistribution, but rather see to what extent they could identify principles which could be applied and make a tax system more efficient with similar progressivity. But it becomes clear that you really have to think about compensatory moves if you're trying to have tax reforms that would make essentially everybody better off, rather than something where the effects are very different for different people. And really, I think looking back on it, we've been a bit evasive on this, because we come up with recommendations that we should move back to a value proportional property tax without really discussing the extent to which one would have compensation for those who find that they have a big change in the tax. Anyway, I thought I should talk about the income tax a bit. Well, it's easy to say that we want a coherent, transparent rate structure for the income tax. We spent a bit of time discussing this point, because so much in the tax system seems to be designed to make it not entirely clear what's happening. And I don't know whether you have the problem that we have in Britain, that some parts of the income tax are called national insurance payments. And some part of the national insurance payments may actually be compulsory saving rather than taxation. In the main in Britain it's taxation. We simply don't, our view was that it was wrong to be mixing things up like that, so that it was hard for people to know what the tax system was doing. Nevertheless, we thought it was justified to have different rates on VAT, to have a number of different taxes in effect. That's it, both tax consumption spending and tax income. Although you might think that this has the effect of making it less transparent quite how much tax people are paying, which comes back to the point I made, that it's really the total tax that you pay either as an earner or as a spender that is a description of what's going on. And this is hidden from people. But it seemed to us, although we didn't have precise empirical evidence to justify it, that the extent of evasion and avoidance on any particular tax, such as VAT or the labour income tax, goes up more than proportionately with the tax rate. That if the tax rate is 20% rather than 10%, then in a straightforward way you have more to gain by evading 20% than 10%. And it seems to us on plausible models that's going to mean that more people will evade, and more, so that the tax revenue lost would go up more than proportionately with the tax that is received. It would follow from that you would prefer a system with some value-added tax and some labour income tax, and in each case you keep the evasion level manageable on these two taxes, rather than putting it all on the labour income tax, for example, which is, in a sense, the most honest thing to do. But of course, there is a difference that for Singapore would be immensely important, I would have thought. And it's quite important for Britain, between the value-added tax and the labour income tax, which is that the value-added tax will be paid by quite a lot of people who visit the country, either as temporary residents or as tourists or whatever. And the labour income tax will not be paid by them. And the other way round, of course, that the value-added tax will not be paid on the consumption expenditure of people who go off and tour in other parts of the world or visit elsewhere and spend there. So there is actually a significant difference between the two, other than what I've spoken of. And it's a kind of difficult balance. My feeling is that in a developing country, that it's fine to try to extract quite a lot of tax revenue from visitors. But I'm not quite so sure that they are doing that at an especially high rate in richer countries. I think you roughly want to justify it in the usual arguments that you should be trying to tax the income of residents, even if they're only there for a short time, because they're enjoying the general services provided in the country by government. But of course they're only enjoying some of them, services of the police force, for example. So it's a difficult one to sort out fully, and it's easier just to go with fairly similar total revenue from the two taxes, and thinking about that. Now we didn't, in fact, get into a discussion of how to deal with the residence issue on taxation, because we thought there were big administrative issues. If you were to try to move to a system where people were taxed more or less on the basis of their time spent in the country, although nowadays you would think that this could be measured quite easily, because going through the computer is very helpful. We still thought that it was going to make it a little difficult for people to know what was going on, and perhaps it'd be hard to pursue people who only spend a week or two in a country for the appropriate share of taxes. And the problem there is a little bit like the corporate income tax problem, that other countries are taxing on the current basis, which should be roughly all income that's earned if you are mainly a resident in another country, that all your world income will apply. Of course, in the case of the United States, it's all world income, no matter how little time you spend in the country. That would be the tax basis. So you don't, I presume you really don't want to break into this system and tax on the basis of time spent in your country if you can't at the same time easily run a double tax allowance system to prevent them from actually paying double tax. Something we looked into in quite a lot of detail was the question whether there should be different tax rates for different ages and circumstances, because the evidence has been quite clear that there are very different labour supply response for people of different ages. Older people have a much more elastic supply response, and that certainly implies that for essentially any welfare function that you would want to tax them on the margin at a lower rate. We would certainly favour that, but it was one of those things where we felt we could only suggest it be considered rather than recommend strongly. A similar case is what I call the second earner issue. Quite often this is the wife. It's not always true that the wife has the lower paid job, and exactly how you define which is the second earner, not clear, but the evidence is very clear that the supply response, again, is much more elastic for the second earner in a household where there's more than one earner, and you get people moving in and out. So that would suggest that the way in which households are taxed that maybe needs some reconsideration. Of course, on the whole, we have pretty much independent taxation currently in Britain, and I suspect that's the way it's going to continue. That you can give some of your tax allowance to your spouse or partner, but that's a fairly small effect. And otherwise, you're pretty much taxed independently. Whereas, of course, to identify which one counts as the second earner, you need to have easily obtained information about the nature of the household. But it's one area that looks as though we're talking about quite large effects. This came up as well in the classic old question of whether something serious should be done to avoid close to, or in the British case, actually 100% marginal tax rate on income at the lowest income levels. This is the effect, particularly of housing allowances in Britain, which get reduced pound for pound as you earn more. So in effect, there is a 100% marginal tax rate at the very lowest income levels amongst those people who are getting labour income. I have actually done models where that is optimal, because this is a model where people like to work up to a point. It's true even if this is only true of most people rather than all people. But on the other hand, the empirical evidence is claimed to show that there's quite a lot of elasticity in moving in and out of the labour force. Let's say, so the lumpy change to going from not participating in the labour force at all to looking for a job and getting a full-time job. So that suggests that you really are discouraging something rather serious by having the 100% marginal tax rate. But the key issue there is that whatever you do, the contribution to national income, GDP, of the lowest income earners is bound to be pretty small anyway. So you don't lose a lot if they're discouraged from working by taxation. On the other hand, I mention this because of the very different attitude of an economist looking at this to many people in many of the people in most countries who say they don't at all like the idea of paying people to stay at home and just enjoy themselves. So one just has to leave that up to the political system to decide. But it seems to me a very interesting fact that Britain has for a very long time had these 100% marginal tax rates at the lowest income level, and they've been quite acceptable. Simple points that income tax should not be applied to the tools of the trade, and to some extent not to saving. What we proposed for saving, which is of course a classical issue in taxation, was that people should be taxed on income from wealth above a normal rate of return. By normal rate of return we meant the interest rate on long-term government debt. And the argument there is that that extra income comes about either by sort of luck, and that's not something we need to worry about tax. And mind you, there should be ideally should be an offset for losses below that level, but we decided not to pursue that side of things, and or otherwise comes from effort and sheer ability. It's much more like labour, and probably is something of a source of inequality even in Britain, even if it haven't been so measured. So that it would be the idea of taxing income from capital with a deduction, a bit like the deduction that was made from capital gains because of price increases, which Britain did for a while and then abolished again. It's very much like that, but says that the deduction should be not the price increase, but the generally available rate of interest, risk-free rate of interest. Retirement saving, of course, sort of special treatment, but actually the returns on retirement saving are generally within that sort of range. But some pension funds may do a bit better, so we recommended that because you know that is definitely postponed consumption, that you don't want to double tax it both at source and when it, so you don't get special extra taxation. People just pay the VAT on the postponed consumption, and you don't tax the return through the pension fund leading up to that. Well, I've talked already about the differentiation of indirect taxes. On the controversial point of transaction taxes, we took the view that these were a bad thing. We couldn't think of any advantages in them. There's rather a large stamp duty, and I think you have the same thing in Singapore, on transactions in property, which is taxing people who have reasons to change where they're living frequently relative to those who don't have any reason to do that, and we couldn't think of a good reason for that. It's quite a large impact on some people some of the time. Of course, that would also mean that we weren't much in favour of a Tobin tax either. And of course, there's no controversy in being in favour of environmental taxes, like taxes on road use. But the person who wrote the chapter on this found that the arguments for how high the tax should be on travel within urban areas was really a remarkably high tax if you're measuring the cost imposed on other people by the congestion, by slowing other people up. Probably much higher than people were likely to accept, and actually higher than, quite a bit higher than any of the taxes that have been proposed because of climate change problems. And we would certainly favour something higher. I mean, this is potentially a very large part of for a time, of tax revenue, except that probably the rate ought to be high enough that that tax revenue is falling off long before you reach these kinds of levels. Business taxes, single rate of corporation tax with no tax on normal return on investment. That's the same principle as we were talking about in savings tax. In other words, corporation tax would be thought of as part of personal tax of people, but because it's paid by effectively anyone in any part of the world who owns some of that company, although they don't see the fact of it being paid, it simply has to continue. I don't think there's any controversy over thinking that you should have the same treatment of income for different kinds of income, but Britain does have some discrimination because of these national insurance payments. And of course the general principle of no taxation on intermediate inputs except because of externalities. I think this was just saying what the others would go on to talk about, so I won't go on any longer. I think I was sent some information about the Singapore tax system, and I think people may want to ask questions about that, and perhaps tell me some more about it. Thank you very much.
Thank you, Professor Mirlees.